Morning, everyone. Thank you very much for joining me. This is the morning market review with myself, Russell Shaw. I'm a senior market specialist at FXCM. My email address, rshaw@fxcm.com. Today is Wednesday. It's the 28th of September. I'm going to just bring up our high-risk investment warning. I'll keep this on screen for a few moments. And here's our market commentaries disclaimer. Again, I'll just give you a few seconds to have a read through that. And our references. So Market Scope, Trading View, Bloomberg. We'll go through the 5 things to know. The email from Bloomberg. I'll just put this this chart up in the meantime. So yesterday I cancelled, so apologies for that. It's a very busy week. Just apologizing for that, but busy with the Q4 report, and then we've got the second part of our day trading workshop tomorrow. A lot of the feedback was attendees would prefer slides, so I've actually got I haven't started working on those. I'm going to work on those this morning, so it's been a really busy week. Hey Howard, morning to you. Nice to have you on the webinar as always. All right, let's just go through the 5 things to start today, which is the Bloomberg email. We've got 15 minutes, and then we're going to switch over to the crypto minute, which we do every Wednesday. So it's a shorter morning market review today. All right, so the first headline reads meltdown. Treasury 10-year yields extended their steepest monthly increase in almost 20 years to top 4% as elevated inflation and rapid central bank tightening drive the global bond rout. The benchmark yield rose to levels last seen in April 2010. And just a day before, the UK government's long-term borrowing costs soared above 5% for the first time in 2 decades as investors braced for a flood of bond supply and aggressive rate hikes. That led investors in many markets to bet on 4 percentage points more of interest rate hikes by May, which would take the Bank of England's key rate to 6.25%, the highest since 2001. Second headline reads, Taxing Times. The International Monetary Fund developed a stinging rebuke of the UK's new unfunded tax cuts by calling them excessive and in need of revision, adding to criticism of a plan which has sent the pound to a record low. The IMF said the Chancellor Kwasi Kwarteng should use a plan scheduled for release in November to consider ways to provide support that is more targeted and reevaluate the tax measures, especially those that benefit high-income earners. The Chancellor will meet investment banks on Wednesday as part of his outreach to discuss the government's growth plans, which have caused turmoil in financial markets. Third headline, more Russian warnings. Russia threatened to cut off the last gas pipeline to Ukraine's European allies and move to annex a large chunk of Ukrainian territory amid a string of military setbacks in the 7-month-long war. Moscow prepared to declare landslide victories in the hastily organized referendums it held in the territories currently occupied by its forces. The United Nations has condemned the voting as illegal. Russia's energy conflict with Europe escalated dramatically as 3 pipelines were wrecked in suspected sabotage, and Gazprom warned that the last remaining route to Western Europe is at risk. Next headline. Can't work there. The European Union is considering a German proposal to ban EU nationals from holding high-paying roles in Russian state-owned companies, according to people familiar with the matter. The proposal, if formally presented by the European Commission and backed by all member states, would cast a wide net over EU nationals. As a result, it would likely scoop up former German Chancellor Gerhard Schroeder, said the people who declined to be named on confidential talks. Let me just read that sentence again. As a result, it would likely scoop up former German Chancellor Gerhard Schroeder, said the people who declined to be named on confidential talks. I beg your pardon. Schroeder is the chairman of the Shareholders Committee of Nord Stream, the measure does not name specific individuals, and it would be up to national governments to enforce the restriction. Coming up, European markets are poised to fall following losses in Asia on Wednesday as global bond rout pushed the 10-year Treasury yields above 4% and the dollar soared. Volkswagen is scheduled to price the IPO of its sports car unit Porsche. Bank of England Deputy Governor John Cunliffe to speak at a conference. Expected data include Swedish, Danish, and Irish retail sales, as well as confidence surveys from Germany, France, Sweden, and Italy. All right. Hey, Anna, morning to you. All right, let's start off with the real rate here. So this is effectively, if you guys have ever heard of TIPS, Treasury Inflation Protected Securities, I think that's what it stands for. This is effectively what we're looking at. We're looking at the TIPS yield here at 1.648, which is effectively the US 10-year. That's your nominal 10-year. And then we're just subtracting the break even off of that. And that gives you your TIPS rate. So that's what the real rate is. And it's just, this is a monthly. So we usually look at a weekly, right? So this is a monthly. And the real rate over this month has been absolutely insane. I mean, take a look at this candlestick. So I can just move this there. And it's just been unstoppable for this month. However, of interest, RSI is pushing to frothy levels. We've now gone overboard on the monthly. We go down to the weekly, and we mentioned this on Monday that the weekly is looking overbought. This is actually a very tricky analysis because the fact that the technicals are overbought, well, how are you going to justify that with underlying fundamentals? And that's really a trick. That is the trick, I guess, with your analysis when we're talking about interest rates. What we can say is that the real yields do seem to react to overbought conditions. Again, we don't have enough data. We've only got 2 overbought conditions, but the real yields do pull back. And the basic idea is that it's very difficult for markets to maintain overbought or frothy conditions for one reason. The probabilities, not sure the probability is not the right word, but the Pareto principle suggests an 80-20 rule. So 20% of the time we're either above 80 or below 20. 80% of the time we're in normal levels, right? So if you spend 80% of your time between 20 and 80, well, and only 20% of your time above 80 or below 20, well then, we would expect to see some sort of normalization. Here's another time we see a normalization. Here's another time. Okay, so every time we get to these levels, the yield pulls back, but it's tricky this time because the data here is limited. So if I go back, I only get data to 2003, the end of 2003, and that's not really adequate for the macroeconomic situation that we're in, because we're in a stagflationary environment. So the data we actually need to see is the 70s and the early 80s, which we don't have here. Nevertheless, I think there is an argument to be made for caution here. I'm of the opinion that the real rates are still on an uptrend. Okay, and it's very easy to justify that on a technical basis and a fundamental basis. Technically, okay, we've got a trough, peak, higher trough, higher peak. We've got the trend line here, which is defining the momentum. So some sort of pullback towards trend, trend wouldn't be abnormal. It would be normal market action. And in fact, as we spoke about on Monday, a third touch and respecting this trend line would actually be welcome, because it turns what we call a tentative trend line in trend line analysis into a valid trend line. So any sort of pullback here in the rates wouldn't be abnormal. And the interesting sort of exercise here is to recognize the fact that there is a fragility in the real yields that seems to be emerging. We'll talk about the fundamentals in a moment, but definitely on a technical basis, we've gone overbought. Now, we know that prices don't move in a straight line. What is interest rates? Interest rates effectively a price. What's it the price of? It's the price of money, right? So we know prices don't move in a straight line. So some sort of ebb and flow, some sort of zigzag here, I think would be normal. The interesting exercise would be just monitoring the psychology of the market, monitoring the psychology of the media, because we've just read that we're flying above 4% on the 10 years. There's almost sort of a I wouldn't call it a mania, but like there's an excitement around the reporting of yield. So if we go down to the to just the 10-year here, all right. So you can see we had 3.99. What was the high here? Okay, so we hit 4. Again, 10-year looking a little bit heated, and let's take a look at the 2 years. 2 years, the short end, much more aligned with central bank policy. Central bank policy here, though, is really driving the. This is where the heat. Yeah, this is where the heat here is emanating from. It's emanating from a very aggressive Fed. We are overbought. I don't think that the 2-year is quite as susceptible to the heat as, say, the 10-year, because the 10-year is very much driven by market participants, where this is more driven by policy. But very interesting just to see the RSI of the 2-year, and of course we'll take a look at this in the cryptos, because we know that Bitcoin at its sort of most frothy was overbought for 6 months, right? So it's just interesting to see that. What this tells me is that the inversion here isn't going away anytime soon, right? It looks like it's going to steepen. So we below 0 on the inverted. So what does this tell us for trading? So let's just go back to the real rate, just link everything up, because we're getting to the top of the hour. Okay, let's take this out. So we know we overbought here. We know we hot, right? Let's add in the US dollar here. Let's add in that correlation coefficient, which we do generally. What am I doing? That's better. All right. So there's the correlation coefficient, and we know that there's a strong correlation. So what we're saying here is, if there is some sort of normal price correction in yield, then it's quite likely that the dollar pulls back. assuming that the correlation stays the same. Where is that correction going to take place? Well, in the bond market, one would think, because market participants will be looking at the bond market, looking for value there now, because it's been decimated. So we're looking at an exchange traded fund called ETF, which is effectively a ETF tracking the belly of the curve, 7 to 10 year bonds. We're looking at the price now, not the yields, and you can just see how the bond market's been absolutely hammered over 2022, and really it didn't do particularly well from 2020. So let's add an RSI here, and then let's think of some basic market causalities, and you can see that we are oversold here. So I wouldn't be surprised to see some value investors trying to get some cheap bonds, because the yields are really good on the bonds, right? And what that would do is effectively there's an inverse correlation between price of bonds and yields. So if there is some value investors that goes bottom fishing, you know, they'll drive prices up, yields, 10-year yields come down, real rates come down. Then we look at that trend line. Then we look at that trend line to hold. Are we going to get that third touch, the valid, the touch that makes it a valid trend line? And if we do, then probably we see dollar pullback. And if we see dollar pullback, then we probably see the other majors moving up. And we even probably see risk markets moving up. And this is something I want to, I'm writing about in the Q4 report. So I've got a little, so we've got the causality goes from real rates to dollar to other financial instruments. Just cut out the dollar, real rates through to other market instruments. And what's going to be very interesting for that is that as the real rates come down, and this is of course very much speculative now, we've got to see if it happens. Remember, the overbought condition is on the weekly chart, the monthly chart. That's not going to help us with our timing. It could take 3 or 4 or 5 weeks before the normalization, right? So there should be a crypto this morning. Yes, there is a crypto. There's a crypto, Howard. That's weird. I think I know what's happening there. I'll speak to you about that afterwards. But so anyways, just to finish off that thought, the real rates come down, risk markets start bouncing, dollar, the majors appreciate against the dollar, and then you watch the headlines. Then watch the headlines, okay? Because then the headlines are going to be very tricky. They're going to start talking about the potential for a bottom. Have we bottomed? Has the bear market bottomed out? And you know, as long as the real rates remain on this uptrend, it's going to be very difficult to make that type of argument. But the way that we will, of course, monitor it, so I'll just bring up the SPX 500, is with the COPOC, right? So we don't have to guess. We don't have to guess when the bottom is. We'll let the bottom come in. We'll be happy coming in a little late, but we'll have more confidence in a bottom. So we'll just bring up the COPOC here, and the COPOC certainly hasn't given us any reason to to accelerate just yet. We're under the zero. We've got to wait for it to kick up. Wait for the real yields to come down. Watch the headlines. Listen to the call for potential market bottoms. That might be sort of the final capitulation. That might be the last sort of bear market rally. It might not. Just keep that in the back of your mind, okay? That I think the yields are worthy of a normalization. Right now, Subject to correction and more information, I will view it as a correction in a longer term, in a broader uptrend for interest rates. Let's carry on this discussion. We'll do it in the Crypto Minute. Thanks very much, guys. See you there.